Mortgage rates just dropped. Now, those of you who bought a home in 2023 or 2024, you're probably seeing those headlines and thinking one of two things. Is this finally my chance to catch a break? Or should I refinance right now before rates go back up? Before you call your lender or fill out an online application, let's slow this down a little bit. In this video, I'm going to walk through three things. First, what's actually been happening with mortgage rates since January of 26. Secondly, what's really driving those moves behind the scenes. And third, and probably most importantly, how to decide in a calm, numbers-based way whether a refinance makes sense for you or not. You know me, guys. No hype, no rates are crashing to the 2% nonsense. Just the math, especially for those of you here in the Midwest who bought a home in the last 2 years. Reacting emotionally to rate improvements can be expensive, but understanding them can actually save you thousands. Back at the beginning of January 26, the average 30-year fixed mortgage rate was sitting in the mid 6% range. As we moved throughout the month and into February, we saw swings up and down. Ultimately, after all the fireworks, things kind of leveled off as we continued on the path of painfully slow improvements as we started to near the lower 6%. Meanwhile, that 10-year Treasury, which mortgage rates tend to follow, was hanging out in the low 4% range, where it's been fairly comfortable for the last few months. Now, quick translation, in plain English, things looked cautiously better than they did at the start of the year, but we weren't quite in the range that I feel like buyers and sellers and potential refinancers could get really excited about. The bond markets were hopeful that inflation would slow and the Fed could start up their considerations of more potential rate cuts. But hopeful never seems to end up looking anything like stable. Since January, rates haven't just marched straight down. They've bounced around. I mean, a lot. The majority of the day-to-day volatility came from these four things. Driver number one, the inflation reports. Every time we got new inflation data, those CPI and PCE reports you hear about on the news, the bond market, they always react. The best way to sum up the market's reaction and corresponding effect on interest rates is as follows. When inflation numbers come in higher than expected, investors get nervous and rates go up. When inflation numbers come in as expected or lower than expected, the rates reacts a little bit and start to move lower. Even a tiny surprise can cause a big swing in your mortgage quote in a single afternoon. Driver number two is the national jobs and employment data. When we get strong job numbers, lots of hiring, low unemployment, the market thinks, okay, the economy seems to still be running strong. The Fed likely isn't going to feel any rush to cut their rate. So when that happens, rates tend to push up. When job growth is reportedly slowing down, rates tend to drift down on the anticipation that the Fed may need to cut their rate in order to provide the economy some relief. Driver number three, the Fed's mood. Interestingly enough, sometimes it's not what the Fed Reserve does. It's what they say. Nothing drastic like a policy change even needs to take place. Really, it's a little bit about what they say, but maybe more about how they exactly say it. Typically, if they sound cautious, rates drift higher. If they sound confident about beating inflation, we see rates improve. Driver number four, the Treasury supply. This one almost never makes the headlines, but it's huge. The government is constantly issuing new Treasury bonds for investors to purchase, which helps fund the deficit. When there's a massive supply of bonds hitting the market, investors will demand a higher return if they're willing to buy them. The result of this then puts a sort of stopper or floor under how low mortgage rates can realistically go. So all of these favors have played their own unique roles over the last few weeks. But even with all that activity, rates haven't collapsed. They've been volatile. As a potential home buyer or a current homeowner looking to refinance, hearing volatility in the market might not seem like a good thing. However, volatility is where opportunities are created for yourself if you know how to run the numbers. A lot of people who bought their homes in 23 or 2024 likely have their interest rates somewhere between 6.75 and 7.5%. So when they see rates dip into the mid sixes, it's natural to ask, am I missing an opportunity to lower my payment with a lower interest rate? The truth is in the numbers, not just the rate. The mistake people make is refinancing just because rates went down a little bit. All right, I want you to look at this specifically. Usually a refinance makes sense if you can get a drop of roughly 0.75% to a full percent. A tiny move like 0.25% rarely justifies the thousands of dollars in closing costs, unless you're fixing something else like removing mortgage insurance. So if you're at a 7.5% and you could get a solid 6.5%, that's worth a conversation. If you're at a 7% and today's quote is 6.875%, put your wallet away. Okay, so let's run a real life scenario. Say you bought a home here in Sioux Falls last year. Your loan amount was $350,000. Your rate, that's 7.5%. So that puts your principal and interest payment around $2,450 a month. Now, you get a quote for 6.5%. Your new payment then drops to principal and interest of $2,210. So back the napkin math, that's going to save you about $240 a month. Sounds great, right? But wait. The refinance isn't free. Let's say closing costs, lender fees, title work, appraisal, that's going to cost you around $4,500. Here is the math that almost nobody does. Divide your costs, that $4,500, by your monthly savings from the refinance, that $240 a month. The result is 19. That means it takes 19 months of those lower payments just to break even. So then you got to ask yourself, am I 100% sure I'm staying in this house for at least 2 more years? If you plan to move in 12 months, do not refinance. You will lose money. Now, is this your forever home? Then that 19-month break even looks like a slam dunk. There's one other factor. Equity. Many of you bought with FHA loans and small down payments, but since then, 2 things have happened. Values in the Midwest have held strong, or they've increased, and you've been paying your principal balance down. You might now have enough equity to refinance from an FHA loan to a conventional loan and drop your mortgage insurance entirely. In that case, the savings might be huge. Even if the rate drop itself is fairly small, it's still a very strategic use of a refinance. As for the future, look, nobody can predict the exact bottom. If you wait for the perfect lowest rate, you might miss a good rate that saves you money right now. Don't try to time the market, time your math. All right, here is my take a serious look list. This is going to be anyone with a rate above 7%. FHA borrowers still paying monthly mortgage insurance, and anybody planning to stay in their home for at least 3 years. If you're already in the low 6s or you're planning to move soon, just sit tight, enjoy your home, you're fine. Here's the bottom line though. Rates are moving because of inflation and deficits, not magic. Refinancing shouldn't be an emotional reaction to a headline. It should be a boring, calculated business decision. Here's the thing, if you want help running those break-even numbers on your home, whether you're right here in Sioux Falls or really anywhere in the Midwest, reach out. Send me your current rate and your current balance. I'll help you do the math so you know your next move is the right one. Thanks for watching, and I'll see you in the next one.